Hello, my name is Bobby Jones, and I'm a retired nurse anesthetist turned alternative investor. I'm also the founder of On Call Capital, an equity firm that seeks to educate fellow healthcare providers and working professionals about alternative investing, while also providing you with opportunities to do so. One of the most accessible pathways for getting into alternative investing is through an investment in a multifamily property. In the commercial space, this means anything that is over 5 units. If you see a nice little eightplex for sale in town, then you can count on that being a commercial real estate transaction instead of a standard residential real estate transaction. This simply means that the property will be valued differently than if it were residential. But if it's so different, then how do we actually come up with multifamily property values? Well, there are 6 different methods for determining multifamily valuations, with some being more common, more accurate, or just plain easier and faster to use. It's not uncommon for multifamily investors to use a couple of these approaches to determine an acceptable range, depending on the type of investment property they're trying to evaluate or the type of business plan their team is comfortable with implementing. The first approach to valuation is called the income approach. This is a go-to approach for most investors and uses the property's net operating income, which is a property's income minus expenses for a given year, as the basis for value. Don't think of it as purchasing a brick and mortar property, but instead, you're actually purchasing an income stream. The calculation itself is relatively easy. It's the NOI, which is the net operating income, divided by the projected capitalization rate, or cap rate. Cap rates can fluctuate based on a lot of factors. For a more in-depth explanation, check out my video on the subject in the education playlist. But a higher cap rate generally means that you're paying less money, but taking a little bit more risk for your income stream. A lower cap rate means that your property is more expensive, but possibly more in demand and could be less risky. So for instance, if you purchase a 100-unit building that has an NOI of $160,000 at an 8% cap rate, then you will expect the valuation to be around $2 million, since 160,000 divided by 0.08 equals $2 million. But if you look in a more popular area that's more in demand, the cap rate there might be closer to 4%, meaning that your purchase price will actually be $4 million instead. So as you can see, cap rates can make a big difference. But this isn't the only approach you can take. Next up is the sales comparison approach. Now, this is a little bit more like residential real estate, where the value that you have is dependent upon recently sold comparable properties in the area. In multifamily, this is often broken down into price per door, meaning that if a nearby property sold for $80,000 per door, you should expect to pay somewhere near that if your property is similar in age, class, and condition. This method can give you a rough estimate of value that you can then use to examine properties in a given location. Another method is the cost approach. Now, let's say, for instance, that it costs $1.5 million to build the apartment building and the land is worth $500,000. Then the cost approach would say the building is worth $2 million. It's pretty easy. You can guess that this is used for new construction projects and properties that don't quite fit the mold of the income or sales comparison models. Primarily, it's used by insurance agents to determine annual premiums, but it's often combined with the income approach to construct business models that show profit potential for new construction. Let's keep going. If your potential property needs a full reposition, it can be helpful to look at the Arv Appraisal Approach. Commonly used by fix and flippers, ARV is the after repair value, and that's an estimate of property value after it's been repaired. In short, you subtract the cost of repairs from the ARV and a profit margin that you've predetermined to arrive at an estimate of the current market value. We're not done yet, though. Let's talk about the gross rent multiplier approach. Like the income approach, this method is based upon the total rents of a property. For each market, property type, and asset class, there is a gross rent multiplier, or GRM, that is used to determine property value. Take the annual total rents and apply the GRM, and voila, you now have a property value. This is similar to the 1% rule for single-family homes, but we use annual rents instead of monthly rents. And no, it's really not the most accurate, but it's pretty quick and pretty easy to use. Lastly, I want to talk to you about the discounted cash flow approach. This one's kind of fun as you project the value of a property at a future time and work backwards to determine the value of the property right now. There's a lot of money flowing into multifamily at this time, and some operators are seemingly overpaying for properties. However, the discounted cash flow approach is to blame for at least a few of those purchases that you see, as operators determine that the property is actually worth much more than its current income indicates. The method is best applied to properties that still have a lot of upside potential, or those in markets where a significant amount of appreciation is expected, like the Phoenix, Dallas markets, some of those other ones that you've seen just explode over the last few years. Now, when valuing a property, it's important to know your own business plan and goals so that you know whether or not a given value works for your team. There is so much more to multifamily valuation than NOI divided by cap rate, after all. And other teams out there will have different business plans and different valuations than your own. So to sum it up, a property is simply worth what someone else is willing to pay for it. I've heard stories of operators who overpay and stories of those who miss out on properties because they're not willing to adjust their own metrics. Whether or not you end up in that sweet spot, right in between, depends on your own risk tolerance, market knowledge, and the team members that you have and their ability to build and carry out the business plan. And about a dozen other factors, if we're being honest. But hey, we'll just save that for another video. Now, that's going to do it for this one. I hope that this info helps you out on your investment journey. If you found this information helpful, it's great if you could just give me a thumbs up and subscribe to my channel. I really appreciate all of that positive feedback. And if you have questions or comments about the info that I've presented, feel free to comment right below. If you're interested in getting access to passive real estate investment opportunities or other alternative investment opportunities, reach out to me here or on Facebook, LinkedIn, or Instagram, or at my website. It's www.oncallinvestments.com. Thank you for watching, and I'll just see you on the next video.